Today we're talking to Lauretta Reeves, who is affectionately nicknamed Retz. She is the International Equities Portfolio Manager and a Wealth Management Advisor at Bastion Fiduciary. And Retz has had an extremely interesting path to where she is now, including working with Sir John Templeton, one of the greatest investors of all time. So she's got some pretty interesting stories there. But Retz is a CFA charter holder, and she's a member of the CFA Institute. Currently, she's a member of their practice analysis working body. She's a member of the CFA Society in North Carolina, and she belongs to an organization in the Triangle area up in North Carolina of the Business and Professional Women's Group. She holds a designation of Accredited Wealth Management Advisor from the College of Financial Planning, and she's got her BBA from Florida International University with high honors and an MBA from Nova Southeastern University. So with all that, here's Lauretta. All right, Retz. Well, thanks so much for your time today. I really appreciate it. Just wanted to kind of talk to you today a little bit about kind of how you got to where you're at and sort of what your investing philosophy is. So, I guess you've got a really interesting story. Can you kind of explain how you got to the point that you're at now?
Oh, thank you. And thank you for talking with me today, Kirk. And they're from pretty humble beginnings. Actually, I started as a statistical typist trainee at a brokerage firm in Pittsburgh and was going to school at Pitt at night. And eventually I moved into the trading department and eventually moved to Miami to work in some trading departments there while I was studying microbiology at night. And then eventually got my undergraduate degree in business at Florida International University. After that, I was fortunate enough to move into institutional trading at Templeton, Galbraith, and Hansberger, and also got my MBA while I was there from Nova Southeastern and got kicked up to the research department. And my microbiology background helped because I became the global pharmaceutical analyst. So things work out how they work out. And after I finished my MBA, they encouraged me to go get my Chartered Financial Analyst charter. And that took another year and a half or so, but I was able to do that and grew into the role as a portfolio manager.
Okay.
After Franklin...
Just for people who don't know, the CFA's, it's the big deal for investing side of things.
Well, thank you for saying that. I don't know that everybody realizes back then it was a pencil and paper for the most part to take the exam. And actually there are 3 exams that you had to take over 3 years. It's shortened now because of the use of computers, et cetera, in order to take the exam. But it was a lot of studying. But I did achieve it. And then Franklin bought out Templeton, Galbraith, and Hansberger, and Tom Hansberger crossed the street basically and started his own firm. And he interviewed me in the parking lot after we were on the same plane. And I went to work for him, eventually becoming the co-chief investment officer of our value strategy.
Okay. And so when you were at Templeton, did you have interactions with Sir John Templeton at all, or?
Yes, I did. When I started in the research department, I was responsible for updating our database and putting the stocks on the buy list or the watch list or the sell or whatever. And after our research meetings every week, we would fax, if you remember those days, fax the research reports over to Sir John, and he would approve or disapprove the reports. And one time I remember, I think it was the Gap, somebody had recommended the Gap, and he wrote back, "It's just a fad. Jeans are just a fad," and he went to prove it when it came down to it. But also, he was based in Nassau, and especially when I was in the trading department, I would have to fly to Nassau and go and sit in the trading department there and trade some of his international stocks, which was, the trading department was actually in an apartment. And one time we had to leave because the person in the apartment next door started a pan on fire on their stove. So it was pretty exciting. Those days were pretty exciting.
So what was he like? Obviously one of the greatest investors of all time. But what were your interactions with him?
Very understated, very humble, very understated. And maybe that's why people listen to him, because you had to listen closely. But just had made up his mind that this was going to be the way that the world was going to go forward, was to start investing in the US, but also abroad. And that institutions were going to be a big part down the line of investing people's retirement funds. And he believed in value. He believed, which is how I believe too, and looking at a stock to see in the long term whether it's a good value with a good strategy. At one point, he would not buy any stock that was trading more than 4 times its PE.
Wow.
And I have to say that's a 5-year out number, looking at what it's going to earn 5 years. But still, there have been times when stocks have gotten that cheap since his time, but not very often.
Okay. Okay, so you basically leave then Franklin Templeton, I guess, and become a co-CIO, and then how did your path end up at Bastion?
Well, I was with Hansberger for about a little over 15 years, and the last 10 of them, I was going from the Keys up to Fort Lauderdale every week, and traveling also about 100,000 miles a year, because we had offices in Mumbai, Moscow, Hong Kong, and Canada. And so I had to visit the offices every year, and then I was still a portfolio manager and an analyst. And after all that time of commuting and traveling, I said, I gotta take a break. And so I decided to go and stay in the Keys. I got my accredited wealth management advisor from the College of Financial Planning, because I figured I was probably going to have to expand my horizons as far as how I could be useful to people in the Florida Keys. And I talked to several people, thought about working with some other people, but Cal and I connected on a coffee shop, and I saw what his vision was, and he did not have a lot of international exposure for his clients. And so we thought that this would be a good, really a good matchup.
Okay, great. So jumped down with the Lauretta Investment Management, which now has morphed into Bastion Fiduciary. Okay.
Yes.
So you've already alluded to it a little bit, like you're a value investor, but yeah, how do you sort of approach investing? What are your philosophies on it?
My philosophy is that I'm investing alongside of a company. They're investing their assets and I'm investing in them. And so I would like to look to what I think the company is going to do over a business cycle, as opposed to what it's going to be doing quarter to quarter. So I actually build out income statement and balance sheet and cash flow statement for companies for over a business cycle to see what their potential earnings are. And to do that, obviously, it means you have to dig pretty deeply into the company. A lot of times I visit most every company that's in the portfolio I've visited one time or another, and sometimes 10 times when it comes down to it. But there's plenty of information too online these days, as almost every company does a quarterly call, a yearly call, and most of the time they're willing to pick up the phone and speak with an investor as far as what their long-term plans are. And that's what I mean, you can always get quarterly numbers, but what I really want to know is what are they going to be doing? What's their strategy for the long term? And after I consider that, management is extremely important. The strategy is important, how they're going to execute it. What are the leaders of the company? How much can you trust them? Which is definitely an issue in investing. And then I look to see, okay, what is the valuation of the company versus what is its historical valuation when I look out over a business cycle? And also, how does that compare with other stocks in its industry as to whether or not it's an attractive value? And even then, is the whole industry overvalued? Is the industry undervalued? And definitely, especially in international, what's happening globally, geopolitically, and economically have to factor into what you're looking at for the companies.
Okay. And like when you look at valuations today in general, like are you sort of shaking your head, or are you kind of looking at what Buffett's doing, just raising cash and thinking that's the way to go right now, or what are your thoughts on valuations?
No, in international is still trading, depending upon what metric you use, between a 20 to 40% discount between what industry you're looking at, what country versus that of the US. That does not mean that every stock is attractive in every country, in every industry. For instance, we just had a big run up in the healthcare sector, which of course I'm familiar with because of what happened towards the end of last month. And now I'm starting to raise cash in that sector. So it's selective. It's very selective.
Okay. Like how do you also factor in then, because you're looking internationally, you got to deal with a lot of different governments, a lot of different central banks. I mean, how do you factor that into your investing?
Well, you have to do some scenario analysis. And right now we're seeing actually a moderation of interest rates abroad. That some countries like Japan had raised rates because they were in such a deflationary period for so long. Now that they're starting to raise rates, it means that they're normalizing, which makes the market attractive. And other countries, it's all a mix when it comes down to it. So you just have to take all that into consideration and do some scenario analysis when you're looking at the stock. And if there's a lot of uncertainty, then you really have to discount your earnings expectations.
Okay, so that's how you focus on it. So if you'll discount the projected future earnings if you feel like the government is, a little shaky or some instability in the region.
Yes, and some places you just don't invest. I'm not invested in Russia. There's not invested in a lot of countries in Africa, although there is some opportunity there. But it's a challenge to really understand how things are going to evolve there. But it's of interest. So there's some places you avoid, some places you discount the earnings, and in some cases you say, well, this is just business as usual.
Okay. Well, like right now, do you stick mostly to developed international markets, or do you have a decent amount in emerging?
I do have some in emerging. I do have some in India in the tech sector. That was actually had done very, very well for a long time, but it was a drag on performance the last quarter when it comes down to it. I have exposure to Korea, as a matter of fact, and some to China through the ADRs that are related to those stocks that are trading on the Hong Kong exchange.
Okay. And when you invest in China, do you ever think like the numbers are like, do you feel confident the numbers are what they say?
For the companies that I'm invested in, yes, especially since they're trading on the Hong Kong exchange. and there's typically more disclosure. And there's only a few direct investments that I have in China. I do have some, well, direct investments as far as their Chinese domestic plays. Okay. But I do have a lot of stocks, some stocks in Asia that have a business in China, like Hong Kong Shanghai Bank, which is actually more of a global company, but it's got a big exposure to that region.
Okay. When you sort of look right now at the United States markets, I mean, it seems like historically you've had international outperform for a kind of a secular 10, 15 year, and it flips. And do you think we're getting closer to the point where people are going to start to realize there's value in international markets? Do you think we're maybe hitting a secular trend there?
Well, I think that's what happened this year. Is that internet, depending upon which index you look at, there's almost 1,000 basis points of outperformance year to date. And so I think the idea of diversification, which for a long time people didn't think of investing internationally as diversification, or at least it was forgotten. I think they're starting to realize that it is, because there's a lot of changes going on within the U.S., and there's been a lot of movements in the currency. Mm-hmm. And that is a diversifier when it comes down to it, is to have exposure to other currencies within your portfolio. Absolutely.
Yeah. Yeah, we'll see. They always say 1 year does not make a trend, but at some point it's got to turn. And even when you compare, growth and value, have you seen the same outperformance of growth over value in international markets as we've had here in the U.S.?
No, it's definitely been more of a sector rotation off and on. I would say though, this last quarter especially, you saw a big run in financial companies, which typically are considered on the value side, and that goes back to the moderation in interest rates to some extent, and a steepening of the yield curve depending upon where you are. We've also seen, when I look at, I have two value portfolios that I run, one that's more generated towards income with better dividend yields, and one that's more capital appreciation. And they're pretty close as far as performance, but I did see a bit more interest in the dividend paying stocks, which is during periods of uncertainty. You tend to see people go that way because it's income that's not the same as income that you're going to get from bonds. Sometimes they can go in lockstep, but the international markets now, especially on the value side, are diversifiers for both U.S. investing, equity investing, and for global bonds. Okay.
When you think about a typical American investor who's probably got 90% or more of their portfolio in U.S.-based assets, whether it's bonds or stocks, what do you sort of recommend people might think about as far as allocating to international equities?
Well, as you know, we have to look at what's the risk tolerance for the client. But part of that is that it's very risky to have all of your equity assets in the U.S. when it comes down to it. And that's something that we saw quarter over quarter this year because of the volatility. But it's always remembering it's the client's money. And that's something you have to keep in mind first. But I would recommend, if making them more comfortable with investing internationally, talking to the client about the idea of, hey, if you're not investing abroad, you're not getting into Nestle, you're not getting into Glaxo, or now it's GSK and AstraZeneca and all these other companies that you buy their goods. You're actually investing in them through what you purchase. So actually your investments in your equities should start to match your basket of goods and services that you buy. If for someone who's very domestically focused, to start gradually investing internationally in a good large cap type of vehicle is probably a good idea. Hopefully to get them up within their equity basket to 20 to 30%, I think is a good idea. One of the ways that I look over time as far as what's a balanced between international and US is to look at some of the global benchmarks and see how much they have in the US and how much they have in international. Now that changes, and that has changed. At one point it was 50-50 back after the euro came in. But over time, it has been more of a 60-40, 70-30 sort of match.
Okay. More concentrated in the US, I assume, right?
Yes. Okay. Thank you. Yes.
Okay. Well, yeah, I don't know if there's anything else you want to tell us about what you're thinking on the international markets, but yeah, this has been really great. It's been great getting an understanding.
Well, we do have various letters that we post on our website. I do a monthly letter. I just posted a quarterly letter, and actually a 9-month update. So I think that might be a good start to look at that portfolio as well as the other specialized portfolios that we manage.
Okay. Yeah. And just so people know, they can go to lastbastion.com and they can sign up for the newsletters right there. Like Rhett says, it's you can pick either different portfolios to follow or you can sign up for all of them together or whatever you want. But yeah, that's a great way to sort of track what you're doing and some of your thoughts and some of the companies you're covering. So
Thank you.
Well, yeah, thanks so much for your time, Retz. And we'll make sure if anybody reaches out to us that they'll be able to get in contact with you.
That's fine with me, Kirk, and I really appreciate your time too.
Okay, thanks so much.
Thank you.
Saving Yourself from Wall Street is hosted by Kirk Kinder, Certified Financial Planner. He is the Director of Financial Planning at Bastion Fiduciary, LLC, an independent fee-only financial planning firm. Bastion Fiduciary, LLC is regulated by the SEC in accordance and in compliance with securities laws and regulations. Kirk Kinder and Bastion Fiduciary, LLC does not render or offer to render personalized financial, investing, or tax advice through the Saving Yourself from Wall Street properties. Information provided is for informational purposes only and does not constitute financial, investing, tax, or legal advice.